Welcome to Talk Tickers. You're with us for the key insights straight from the latest earnings calls.
That's right. We cut through the noise.
Today, we're digging into Dole PLC. Their first quarter results for 2025 just dropped.
Yep, let's get into it. So overall, a pretty positive start to the year for them. Actually beat their own forecasts.
Oh, interesting. How did the top line look?
Group revenue on a like-for-like basis was up 4.2%, hit $2.1 billion.
Okay, solid growth there. What about profitability?
That's where it gets a little mixed. Adjusted EBITDA was actually down 2%, landing at $14.8 million.
Okay, and net income?
Adjusted net income came in at $33.1 million, and the adjusted EPS was 35 cents.
Which is down from last year, wasn't it?
Yeah, down from 43 cents, same time last year. So revenue up, but some pressure further down the P&L.
Gotcha. Anything else jump out from the summary numbers?
Well, they did announce a dividend increase, 6.25%, bringing it to 8.5 cents per share.
First increase in a while, isn't it?
It is, yeah. First one since they started paying again back in 2021. Shows some confidence, you know?
Definitely. And they mentioned refinancing.
Right. After the quarter ended, they wrapped up a big $1.2 billion refinancing. So they got favorable rates too.
Okay, good snapshot. Let's dive deeper then. Fresh food, that's huge for Dole. How did that segment do?
Really strong, actually. Adjusted EBITDA was $63.3 million. That was better than they were expecting.
Even with the storm, Sarah, was it?
Exactly. Despite the headwinds they thought they'd face from that tropical storm.
So what drove that strength? Bananas?
Yep. Strong banana volume growth, particularly North America. And pineapples and plantains saw some positive movement too.
But costs were higher. You mentioned profitability pressure earlier.
Yeah, it was slightly impacted.
Yeah.
Higher sourcing costs, higher shipping costs, partly recovering from the storm, getting things back online, and partly just scheduled dry dockings for their ships.
Makes sense. Are they getting production back on track from the storm damage?
They are. They're working on it, expecting to be pretty much near full recovery by early 2026 on those affected farms.
Okay. And Europe, how did fresh fruit fare there?
Pretty stable, actually. Banana volumes grew nicely. Pineapples did better, too. The main challenge was banana pricing. The weaker euro hurt them there.
Right. But the euro has been strengthening lately.
It has. So looking forward, they see supply and demand being pretty balanced for bananas and pineapples. And yeah, that stronger euro could definitely give them a boost,
Yeah.
a potential tailwind.
Okay. Moving on. Diversified NA segment. How about that one?
Very strong. Really stood out. Like-for-like adjusted EBITDA jumped up at $27.7 million.
Wow. Driven by revenue. Margins.
Both, really. Strong revenues, and they managed some margin expansion, too.
And the euro impact again.
Same story. Weaker euro dampened things a bit, but the recent strengthening, that should help here as well, become a tailwind.
So performance varies a bit within that segment.
Yeah, different areas doing better than others, but the overall picture, especially on the retail side, seems pretty good. They're focused on investing, both internally and, maybe looking outside for opportunities too, to keep that momentum going.
Got it. Now that other diversified segment, Diversified Fresh Produce Americas and Rest of World. Bit of a mouthful.
Yeah. It is. But strong results there too. Double-digit like-for-like growth in adjusted EBITDA in Q1.
And that's after accounting for selling Progressive Produce. Right.
Exactly. You have to factor that disposal in. The growth came mainly from good results in their North American markets.
What about the exports? South America?
That saw a bit of a dip, but it was more about returning to normal, really. Last year was unusually strong, especially for things like Chilean cherries. So this year was more typical supply and market conditions.
So they feel well positioned for the year.
Seems so. They feel good about 2025, but they're keeping an eye on, global trade stuff. Always have to.
Okay. Fresh vegetables. You said earlier this one's a bit different.
Yeah, it's in process. They're still trying to figure out the best strategic path forward for that whole business.
And performance-wise?
It was weaker. Tough comparison against a really strong prior year for fresh produce markets generally.
But was there anything positive within vegetables?
Yes, the value-added side. That part held up okay, showed stable performance, and actually signs of getting more competitive, better delivery, lower costs, more innovation. So maybe some green shoots there.
Let's pull back to the overall financials again. Reported revenue was slightly down, you said, despite that like-for-like growth.
Right. Reported revenue dipped 1% to $2.1 billion.
Yeah.
Two main things. Selling Progressive Produce, that revenue is just gone now, and then the currency translation, the weaker euro we talked about.
But underneath that, the core business grew.
Exactly. That 4.2% like-for-like growth shows the organic strength, especially in fresh fruit and diversified NA.
And the drop in net income year over year.
Mostly because last year they had that big one-off gain from selling Progressive Produce. Plus, this quarter they had some unrealized losses on foreign exchange.
Okay. And the adjusted EBITDA and EPS being down. Connect those dots again.
Sure. Adjusted EBITDA took a hit mainly from fresh fruit, those higher costs, and again, Progressive Produce not being there anymore. Like for like, the EBITDA decrease was only 2%, which isn't too bad.
And that lower EBITDA plus higher depreciation hit the bottom line.
Precisely. Lower adjusted EBITDA plus higher depreciation costs flowed through to lower adjusted net income and that lower EPS number.
Gotcha. What about interest and CapEx? Look like those were up.
Interest expense was $17.2 million for the quarter. They're guiding to around $70 million for the full year, assuming rates stay sort of where they are.
And spending, capital expenditure.
Yeah, cash CapEx was $52.8 million in Q1. That included buying out some vessel financing deals, plus investments in farms, tech, that kind of thing. Efficiency and growth stuff.
And leverage ticked up a bit.
It did. They had a working capital outflow, which is pretty normal for Q1 sometimes. Pushed net leverage up to 1.9 times. But they expect that to sort of unwind later in the year.
Did they sell any assets?
A little bit. $4.8 million, mostly some land in Hawaii.
Okay, so where's the money going now? Capital allocation priorities.
They're keeping options open. So a lot depends on what happens with the vegetable business. That decision will influence things.
But the refinancing helps, gives them flexibility.
Definitely. They stress that. More flexibility now for growth initiatives. And they are actively looking at acquisitions.
Oh, really? What do they say about that?
Just noted that, some private equity owners might be nearing the end of their investment cycles, creating opportunities, and they see a gap between private market valuations and where public companies like them are trading.
Interesting. And commitment to the dividend.
Seems strong. I mean, they just raised it, right?
Right.
So that signals commitment to returning cash to shareholders.
What about internal investments, not just buying things?
Oh yeah, lots going on there. Big projects in plantains, some joint ventures, pushing automation tech in their facilities, expanding buildings, quite a bit of internal development.
So putting it all together, they raised their guidance for the year.
They did. Feeling pretty good after Q1, despite, the macro environment being dynamic. They bumped the full year adjusted EBITDA guidance up to at least $380 million.
And CapEx guidance?
Baseline maintenance spending, they figure around $100 million, roughly matching depreciation. But there will be extra CapEx for the reinvestment work in Honduras after the storm.
Covered by insurance, partly?
Partly, yeah. Insurance proceeds will cover some of it. But overall, they sound confident about handling the challenges and finding growth.
Did the Q&A shed any more light on specific things, like why they raised guidance?
Yeah, they touched on that. Said it was really the underlying performance in Q1 being better than they'd planned, even with the storm stuff. Plus, they expect a bit of a tailwind now from the stronger euro, like we discussed. And yes, current tariffs are already baked into that outlook.
And the vegetable business timeline, any clarity?
Not really a timeline, but they just emphasized it's complex. They want the right outcome for everyone involved. It's still officially discontinued operations on the books.
Okay, and capital allocation tied to that outcome.
Yep, confirm that again. Veggie's outcome matters, but the refinancing gives them room to move regardless. Dividend up, looking at internal stuff, looking at external deals, keeping busy.
Anything else from the Q&A stand out, maybe on the diversified segments?
They did clarify the Diversified America's RW strength, mostly the North American distribution and handling side doing well.
Oh.
South American exports, like we said, more normal after that huge cherry year previously.
And the extra spending in Honduras? Above insurance.
Yes, they put a number on that. Expecting maybe $10 to $12 million extra investment there, aimed at boosting yields and better flood protection for the future. Smart move, probably.
All right, time for our favorite segment. This is not financial advice. Based on all that, what kind of wild, maybe plausible trade idea bubbles up?
Okay. Thinking about Dole doubling down on Honduras, reinvesting heavily after the storm, focusing on yields, flood protection. Maybe there's a play on the companies that build that stuff.
Go.
Like a long position in firms specializing in agricultural infrastructure, irrigation tech, maybe even construction with expertise in that region, Central America. If Dole's spending big on upgrades and resilience,
Others might follow. Or just benefit from Dole spending.
could be a ripple effect, yeah. Or just directly benefiting from those contracts. It's definitely a longer term idea. Depends on Dole executing well, the recovery going smoothly, but
Yeah.
Yeah, infrastructure play on the back of Dole's resilience push.
Interesting. Speculative, but interesting.
That's the game, not financial advice.
Absolutely not. And that wraps up our deep dive into Dole PLC's first quarter 2025 earnings call.
We hope breaking it down like this helps you get a clearer picture of what's going on with the company.
Remember, this is all for informational purposes. Do your own homework before making any investment decisions. Seriously.
Yeah, please do. Thanks for tuning in to Talk Tickers.